Qualcomm is about to lose $7 billion in revenue. Apple is walking away, and on the surface, it looks like Qualcomm is in serious trouble. Most investors see a dead stock for the next few years. But what if that's the exact setup for a hidden 150% opportunity? In this video, I'll show you how Qualcomm's so-called crisis could actually be the turning point for massive gains. Here's what's happening. Qualcomm's contract with Apple for smartphone modems is winding down. By 2027, that's about $7 billion in annual revenue gone. Wall Street saw this and slammed the stock. Qualcomm's valuation dropped, trading at a steep discount because investors assumed the company couldn't replace Apple. Qualcomm's answer? Back in 2024, they laid out a plan to shift focus into three areas: Internet of Things, Automotive, and Industrial. At the time, people shrugged it off. It looked like a desperation move. But if you look closely at the numbers today, those businesses are actually growing fast, and the potential is a lot bigger than most investors realize. In reality, when I started this script, I did it to show that Qualcomm was about to fall off a cliff. On the surface, losing $7 billion sounds catastrophic. For the next couple of years, the stock may look stagnant as Qualcomm looks to replace the Apple revenue. But here's the twist. The growth in Internet of Things, Automotive, and Industrial isn't just plugging holes. These are higher growth sectors. Over the next 3 years, these areas can completely backfill the lost revenue. That means the company can stabilize, even if earnings appear flat in the short term. Qualcomm is currently trading at a huge discount to its previous valuation. The combination of near-term stability, long-term growth, and an undervalued stock is exactly what creates the hidden setup for a massive return. Investors who buy now while the market is focused on the Apple loss could see outsized gains once growth accelerates and the stock re-rates. Potentially up to 150% over the next few years. You're going to want to stick around to the end though to understand exactly how to play this. Now, let's look at the numbers and see how this all translates into potential returns. We're going to focus on the fiscal year 2029 forecast, almost 4 years from now. First, I'm removing the PC revenue entirely. Qualcomm does make some money here, but the products suck, and many laptops using their chips had the highest return rates. The reviews by most YouTubers are horrendous. Let's assume this revenue disappears completely. Looking at the other sectors, Internet of Things, Automotive, and Industrial, growth is tracking at the exact rates they said they would, even without the PC growth. Conservatively, using the fiscal year 2029 forecast, without PC, we get $18 billion in revenue. That's $10 billion of growth over the next 5 years, translating to an 18% growth rate instead of 22%. Modeling fiscal year 2028's revenue at that growth rate gives $15 billion of revenue, up from $8.3 billion of revenue in fiscal year 2024. That's a $7 billion increase, exactly enough to replace the Apple revenue lost. If growth continues, these sectors alone could reach $21 billion by 2030. Now, let's look at the handset business. QCT revenues consist of Internet of Things, Automotive, Industrial, and handsets. In order to get the handset revenue, we will need to subtract the $8.3 billion of Internet of Things, Automotive, and Industrial's revenue. That leaves the handset revenue at around $25 billion. If we now remove the $7 billion of Apple revenue immediately, and we assume it grows at 8% per year, In 5 years, we'd see $26 billion in revenue. Although that's just $1 billion of net growth compared to today, it shows the Apple loss has been fully replaced. We've modeled the handset revenue and the growth revenue of Internet of Things, automotive, and industrial. Now, if we combine those totals, we reach $47 billion of future revenue. That's roughly 20% higher than the starting point, or about 4% per year. But net income growth will likely outpace revenue growth because the new business has higher margins. Back in 2018, when Qualcomm was mostly handsets, earnings before taxes margins were 15%. Today, with the new business mix, margins are around 30%. This higher margin mix makes 5 to 7% annual net income growth realistic over this period. For my growth forecast, I'm assuming a 6% net income growth. The current forward price to earnings is 14, but looking ahead, I'm modeling a forward PE of 25. Why? Future revenue growth will accelerate as Internet of Things, automotive, and industrial businesses begin to take up a higher and higher portion of the revenue. Average growth combining handsets at 8% and the high growth industries at 18% gives us about 13% growth. This trends towards 18% as the high growth segments scale. With this new product mix, 15% or more earnings growth per year is achievable. This is what justifies a forward price to earnings of 25. Reasonable given the future growth profile. This setup delivers a 140% return over 5 years, compared to a projected 76% for the S&P. Put another way, Qualcomm would need to grow 36% before its future return matched the S&P. If growth hits 7%, total returns could reach 150%, giving roughly 42% upside from today before its future return matched the S&P. This is how Qualcomm's so-called crisis today, losing Apple, sets up the potential for outsized returns over the next 5 years. If you've stuck with me this long, join me on Discord. I'd love to chat stocks with you, and since I'm a small creator, you'll be able to talk directly with me. Link in the description. Now for how I would play this stock. Qualcomm is an interesting business with a very promising future return. But here's the thing. We might be able to get even more out of it. Rather than buying in right now, I'm waiting for the market to panic further. As Apple's business disappears and Qualcomm's overall revenue growth stagnates or even turns negative, investors could overreact. I wouldn't be surprised if the stock drops another 20%. If that happens, the share price would be around 145 and the forward price to earnings would drop to 12. If we model the returns from here, using our 6% growth assumption, that would translate into a projected 180% return over 5 years, with a 58% upside from today's price before the future return matches the S&P. If growth hits 7%, total returns could approach 200% over 5 years, or a 66% upside from today. It's a bit greedy, but waiting for a better entry point could unlock significantly higher returns. That's why I'm placing price alerts for Qualcomm. I will continue to monitor the company, looking for the best opportunity to capture this potential upside. To sum it up, Qualcomm is facing a $7 billion revenue loss from Apple, and that has Wall Street worried. On the surface, it looks like a crisis, but when you dig into the numbers, the story is very different. The growth in Internet of Things, automotive, and industrial is real and accelerating. Combined with the handset business, Qualcomm can fully replace the lost Apple revenue within a few years. Margins are improving, earnings growth is strong, and the stock is trading at a steep discount to its future potential. This setup gives us the chance for 140 to 150% return over 5 years, far outperforming the S&P. If we time it right, waiting for further market panic, returns could climb even higher. Qualcomm's so-called crisis today is actually a potential hidden growth opportunity for disciplined investors. Keep an eye on the company, watch for entry points, and remember, the market often overreacts to short-term headlines. This could be your chance to buy in and get a massive upside. Thanks for sticking with me to the end. I appreciate you immensely. Bye.